Hello and welcome to the Monday Technical Market Outlook for September 7th, 2009. This is Patrick Terezna. As always, we start with a weekly chart of the S&P 500 going back numerous decades, and you can see here that when we plot an 80-week moving average, it's done a very good job to depict every bull and bear market cycle that we've gone through. You can see that now we're approaching toward that 80-week moving average, but it's very unlikely that we're going to have a sustainable bull market above it without first having some sort of a pullback from which it could use as a springboard to go higher. So we may have seen the lowest point of the market. We don't know yet, but more or less after the next pullback, we can see whether or not the market will have the strength to start a new bull market from there. When we take a closer look at that S&P 500 using that SPDR exchange traded fund symbol SPY, we can see that we went through a little bit of a market pullback after testing that 104 to 106 zone on the upside. At this stage, we do still think that there is a potential for this to break higher and still retest those upper zones. We do still stand by the thesis that we believe a market top will occur somewhere in that red box between that 104 to 112 area on the upside. Whether or not the high we saw right there was the high, I'm not sure at this stage, but at this moment we can't rule out the possibility that we still have numerous thrusts higher up into that zone. There is a distinct loss of momentum, which is something that accompanies market tops, so will be very interesting to see what we would in terms of when will the market turn down. We're watching this 98 level marked by that blue line. When that 98 level is broken on the downside, and especially if it tests right into that 94, 96 zone on the downside, that will be the real critical moment where we're going to find out whether or not key support levels are holding. If we have any technical breaks below there, that's when we know a market top will have actually come in. Just to review our key points, our thesis since January 2008 has been that we are in a bear market that should last many months, if not more than a year in total duration. We add to that near the beginning of the year by suggesting that this bear market could end as early as the fall of 2009, but can realistically extend into the 2010 time frame. We do at this stage we still do not want to stand in the way of the bulls on the short term. There still could be numerous thrusts higher, even though we're not seeing a lot of momentum. But the one thing we do want to state is that we do believe that this summer rally will end somewhere in this 1,050 to 1,120 area on the upside, and so we're going to be outright defensive in that area as we see a little upside for huge downside risk. That scenario still hasn't changed, so anytime we get any rallies, it's probably an opportunity to distribute or sell your positions. And really at this stage, only short-term actively managed trades are prudent. Longer-term investors still need to be cautious and avoid overexposure to the markets. Next here, I want to take a look at the NASDAQ 100, which is the exchange traded fund symbol QQQQ, and the leadership really has always been in the technology sector, and it's led this rally higher. At the same respects, at this stage, that 3940 focal point has also contained the selling, and the rebound rallies are still pretty evidently strong. At this stage, we can't rule out the possibility that the NASDAQ will still continue to push higher here. Our upside measured move measures as high as the 42.5 to 44.5 area on the upside. If in fact the market is destined to make a couple more thrusts higher, it's not unrealistic for the NASDAQ to reach up into there. In the same respects, if we have any technical breakdowns below 39, it'll be interesting to see whether or not the selling can actually accelerate down into retesting those 36.5 to 37.5 areas on the downside. At that stage, we could also start looking for a bigger picture topping formation in the NASDAQ. Next here, I want to take a look at the US dollar index, and we've been in a very tight trade range over the last month and a half in this 77.5 to 79.5 area. Really at this stage, which way will it go? It still hasn't made the break, but it's looking more and more likely like this US dollar index is going to make a technical breakdown. If we see any acceleration below 77.5 on the downside, we can see a very fast move work its way all the way down into that 75, 76 focal point on the downside. But if on the other hand support levels do hold, if we have a sudden catalyst for a break above 79.5, all of the US dollar shorts are going to get squeezed out pretty hard. So until that technical breakdown actually occurs, be a little bit cautious. Next here, I want to take a look at gold bullion using the exchange traded fund symbol GLD, and we were looking for a technical breakout above 94 to confirm any bullish move, and we got that, and with a very significant follow through, which completed not only hitting into the focal point in the 97 and 99 zone, but also completing that measured move up to the 98 to 100 zone. There's nothing actually stopping there being one or two more thrusts higher, which could reach the 100 to 101 zone on this go about, but realistically, this part of the measured move is complete. Now, if in fact we have any sort of technical consolidations up at these higher levels, let's say over a span of a week or so, with no giving back any of these gains, we can't rule out the possibility that this is a much bigger picture breakout. If this is a much bigger picture breakout, then after any short-term consolidations, we could see a move even as high as the 105 to 115 area on the upside. We'll measure those out in the upcoming weeks. Understand that right now in the short term the move is coming to a completion, but that doesn't mean that this isn't a very big picture breakout. Next here, I want to take a look at crude oil using the United States Oil Fund, which is the symbol USO, and we haven't seen a breakout on the upside like we saw in gold. So really at this stage, it'll be very interesting to see whether that US dollar itself makes a technical breakdown. If it does, it may actually support another push higher in the USO, so we're not in any way outright bearish at this moment. But one thing we do want to stress is that this 34.25 area is going to be an important support line. If in fact we'd have technical breakdowns below that blue line, then in fact we may start visiting the idea that we may have seen a significant top on crude. So it'll be important for support to come in here and for this oil market to reverse on the upside here. Finally, I want to take a look at a broader basket of commodities using the PowerShares commodity ETF symbol DBC. This particular commodity ETF does have a larger weighting in the oils, so we continue to see some weakening in this broader basket. But ultimately, if we do see reversals in oil and in natural gas and numerous other sectors accompanied by US dollar breakdown, we still can see this reverse back on the upside. At this moment, this is a negative breakdown unless we have an immediate recovery, as in like in the next few days we have some sort of a move that brings us immediately back above 22. Then in the bigger picture, this is not a good technical signal. So we'll be watching very carefully here. If it does move all the way back down to the 20.5 to 21 area, that's gonna be a very critical moment in determining whether or not this is going to be a range-bound market, or whether or not in the bigger picture we're going to see some reversals on the upside. That was your Monday Market Outlook. Thank you for joining me.